Good afternoon. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. If anyone has any questions or any chart requests, feel free to type them into the chat. I'd be more than happy to go ahead and get through to them. If you like what you see here, or if you have any questions you want to ask me after the stream is done, you can always follow me on Twitter at StockDarts and ask there. You can find videos and copies of these market reviews at YouTube under the name Stock Darts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, watch list ideas, educational blog posts, and also putting up the recordings of these Wednesday market reviews as well. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. We're going to do that through the ETF SPY. Alright, so as you can see, we have kind of a quiet day today, kind of a quiet week so far, but overall the market is once again in a pretty bullish stance, and this is something we discussed last week. The year started off poorly with a big red candle, and it looked like maybe we were due for some distribution or selling as the year started. But if you remember last week, we noted that on Tuesday and Wednesday there was a pretty big turnaround as far as price action is concerned on the market, and it was hinting at the possibility of a rally and of the bulls being back in control of the market. And that's kind of what happened. As you can see, we closed the week off pretty strong, and then so far this week, while we haven't been that strong, we're kind of holding just above all-time highs, and it looks like we're just pausing, getting ready to try to rally a little bit further. Now the picture's a little bit different as we move forward and we move through the four major market indices, but we'll get to those, the Nasdaq, the Dow, and the Russell 2000 as we move forward. But looking at SPY first, we're going to zoom in a little bit. You can see that we just printed a bull flag, or we're printing a bull flag. And again, this is a nice consolidation pattern just underneath all-time highs, and is pretty bullish. There's nothing bearish about what we're doing right here. We are basically just consolidating. We printed new highs. Now that candle that we printed on Friday to print new all-time highs is not the most bullish of candles. As you can see, when you print a hammer at highs, that shows that there was some selling pressure in the middle of the day. But we did close strong, and then it was followed by another spinning top and inverted hammer, which again is not the most bullish of candles, but in the end all we really have is a string of these four indecision candles, which have basically created a bull flag. And as you can see, volume has slowly died down as we've kind of consolidated. And so while the candles individually are indicating that there is some selling pressure, that's what happens when you have consolidation ranges like bull flags, because in the end there's people taking profits and you do get some kind of selling in there. But generally speaking, this is still a bullish pattern, and it is more than anything more likely than not hinting at a bullish move, bullish continuation move, probably at the end of the week or start of next week. Now we could turn around and of course sell off, and it could be that the selling that we're starting to see inside of this consolidation range continues to grow. But if that's the case, we have warning signs and we have support levels, which we'll get into a little bit, that'll give us a good idea of what's going on with the market and whether or not we should be more concerned or looking at a market that's more range bound. And really what we're getting right now is looks like a market that's ready to rally and ready to extend and push a new leg up in its particular rally. So let's zoom back out for a second, get a bigger picture view. And as we can see, we closed off last year in a very strong move, right? So we had in the middle here around September, October, and even in the very beginning of November, we had a pretty big consolidation range, and we had these two big pushes down. Once we kind of flipped the switch and turned into the middle of November and end of December, we started rallying strongly. We had, what is basically considered a Christmas rally or holiday rally, which we get often. We usually end up the year like this. It doesn't always happen, but very often you'll have a strong push to close out the year, and that's what we got last year. And at the turn of the year was where things got, again, like I said, a little bit dicey. You can see we had towards the end of the year, we had some volatility kind of coming in. We had the market start to chop around a bit, but overall, it was just stair-stepping and climbing its way up. So what we're going to do here is we're going to take our rectangle, which again is, I think, a nice handy-dandy tool to really explain sometimes what's happening with price action. And so just to go back, this was the consolidation range that we had, right? And then we started to build upon that, and we broke out above it. right? And you can see a lot of that consolidation range took place above the previous, what looked like it might have been a double top, right? And so we had this bullish breakout where we broke out and then we started, again, the actual breakout candle was not that exciting, but we were able to build up pressure and build up and continue to kind of push forwards until we were able to rally as we started to head into December. What did we do then? We stair-stepped, right? And so we ended up with a next stair-step and a next consolidation range, which took us into the start of this year. And again, you can see we stair-stepped upwards and we started to range sideways, but we had a very solid floor, which also happened to be the previous ceiling. So again, it was showing this flip between what was previously resistance into support, showing that the bulls are continuing to up their idea of what good value is and what their targets are. And as such, we just continue to climb upwards. And so what are we doing now? We're beginning that process yet again. And you can see it again. We've got a little bull flag, but the process is very similar to what we've done and what we've established over the last couple of months, which is you break out of the previous range and then you slowly build up some steam and try to get past it. Now, so far we only got a 5-day consolidation range, and if that holds and then we break out from that, then that's pretty bullish because, again, it didn't take us 2 or 3 weeks to consolidate like the last two times, showing the momentum is increasing. Now, I do want to point out again that we are still in a pretty strong rally, and the market is still overall pretty strong, and this is also indicated by the moving averages, which is something I've been kind of harping on since the end of last year. Is if you take a look at the 20 and the 50-day moving average, they are trailing. They're starting to really climb upwards again. They're nice and parallel. Now they had spread out, which is typically what you want to see as a move begins. They start to close up a little bit, which is what happens when you start to consolidate and trade sideways. However, they're both starting to come up and follow price again. And overall, again, this is a good sign of bullish behavior. We didn't come down to the 50. We tested the 20 3 times, and then we're able to break out and start pushing back upwards. One second. All right, so overall, we're getting, again, the moving averages are supporting price, and it's indicative of a rally, right? When it's sideways, you can see the moving averages are turned sideways. They're crossing back and forth. They look like spaghetti, and you got price action just chopping back and forth through the moving averages. When you have them up like this, like train tracks, that's showing you a good possibility of a rally, or, well, it's following a rally. And until we start validating those moving averages, you have to assume that the rally is intact. And so that's what we have right now. Again, even the 200-day moving average is climbing upwards, showing that in the long term we are also still rallying, which again you can see more clearly if we zoom out or if we go to a weekly chart. And you can see with a weekly chart, clearly we've had a very strong rally, and we've had a very strong market since we had the drop back in March due to the corona pandemic. And since then, the market has basically left it in the rearview mirror and has assumed that everything's going to be fine as we move forward, and has full confidence in our ability, our economy, to kind of recover and come back to normal. Now, that might not be the case in real life, but the market is always looking forward. It's not looking at what's happening in the current moment. We're also in an environment where the dollar is, where we keep printing money, which is going to inflate the markets, and that's part of what's going on. And my advice to you is, if you like to think a lot about economics or about the bigger picture and the fundamentals, understand that that's not always going to impact price in the short term. That's part of the reason, well, one of the main reasons why I prefer to trade off technical analysis, is because everything is evident here. What I'm trading is market psychology. I'm not trying to guess on what our economy is, what the fundamentals of a company are. Now, do they have any kind of important bearing on what can happen in the future? Of course. But they don't really affect the way I trade, because I try to trade off of short-term market psychology, which is human behavior. And I feel like that kind of encompasses a lot of the fundamental data that you might get in the longer term. And so it's important for you to realize, if you're trading in the short term, try not to get too attached to your ideas of what you think the bigger picture is or what you think the economy is doing, because in the short term it doesn't really matter. We're basically trading off of human emotion, and it's much better if you try to gauge that and try to gauge what the market psychology is, rather than try to tell yourself, well, there's million people that are unemployed right now. Why is the market going up? I don't think it should. I think it should be going down, and you try to short the market and you get punished by it, because in the short term the market doesn't really care. There's a lot of other factors that go into it, this rather than just unemployment, or rather than just what our snapshot of the economy is today. And so it's important that you keep that in mind when you try to trade. Now, I'm not saying to ignore it, but understand its impact on the market, understand its impact on your trading, and try to make sure that you don't let it affect what you're seeing on the chart and what the market is actually doing. Because in the end, the only thing that's important for you trading wise is the price action. And you want to make sure that you are benefiting from the price action. And like I said, for the last decade now, the price action has been incredibly forgiving and incredibly strong, for the most part. And so if you're not taking advantage of this, there will come a time when the market is much more punishing. And if you don't have that buffer from profit that you've made now, it's going to make it a lot harder to stay solvent in that type of market environment. So keep that in mind when we're trading. Is try not to get too married to your ideas, and make sure you follow what the price action is doing, because that's really what's more important. All right, so going back to the S&P 500, looking at SPY, like I said, we've got a nice little bull flag here, and more likely than not, the resolution will be up. And if that's the case, we will continue to be in a strong bull market, and we will continue to rally, and momentum plays and long plays will still work more often than not. If you are worried about this market, if again you have these doubts and you think that our economy can't really sustain a market that's this strong, well, what it would take to change your mind is we need to see a lot of these technical levels that I'm about to point out broken. Like I said before, in a strong market, you've got the 20-day moving average and the 50 running upwards like train tracks, right? The first thing we need to do is breach those moving averages, and we need to turn those moving averages sideways. So if you're worried about the market, you want to see well, I'm not saying you want to, but your warning signals are when price action starts to fall back below these moving averages. Not just the 20, but also the 50, and makes its way towards the 200 in the longer term. As far as the horizontal levels that we're concerned with right now, so a key level and a major level is down here at 364. However, in the short term, we probably want to be looking at somewhere in this area here, right? Which again, not really too coincidentally, is right around the 20-day moving average. So, as you can see, as we closed out last year, we made a run up all the way up to about 372. And then we kind of chopped back and forth. We had an attempt at a breakout here. And then as we started to really get towards the turn of the year, you can see we started getting pretty volatile as we started to try to break back out of that area. We were able to do so last week. And so that becomes the new area that needs to flip from resistance to support. And we haven't really tested it. We're kind of, like I said, consolidating above it and in this nice little pennant here, or bull flag. And so if you're worried about the market, if you think that there is more downside, well, it begins with the immediate downside of this little level of support here around 371, 372. If we lose that, there's a good chance that we come back down and test the 50, which again is probably going to be somewhere just a little bit above this 364, 365 area, which will again be a more substantial area of support. So as long as we hold above 372, I think we're in a pretty strong rally. If we come back down into the 365, 364 area, we're still in a pretty bullish market, but we might be in a more range-bound or neutral short-term to intermediate-term environment. If we lose this level 364, again, long-term, we're still in a very strong bull market. But in the short term, we're definitely in a much more corrective environment, or still at the very least range-bound, as we come back and backtrack and still retest the price action above this area here, which is about 355 to 321. So we've got a couple different areas that you can look at as far as little lines in the sand, or little fighting points that should tell you where exactly the bulls need to hold in order to continue supporting the price action, to continue to leave this as a bullish environment. And it's pretty unlikely that we fail in all of those, but you never know. Now, one thing to keep in mind, of course, we have a transition coming pretty soon. We've got a lot of political instability right now with our president. We got a new president coming in the next week or two, and that could have some impact on the market. We also have a new earnings season coming up, in which we will finally get some numbers on what exactly happened during the holiday season, and that could also have an impact, good or bad, on the market as we head into the middle of January and start to see some of these performance numbers for the holiday season. And so that could impact the market one way or the other. So keep that in mind. Also, because we do have an earnings season coming up in the next couple of weeks, that should impact your trading at the very least by making sure that you are paying attention to each name that you trade and understanding the volatility or risk associated with a name when it reports earnings and making sure that you are avoiding those if it's not part of your overall strategy to try to take advantage of that volatility. So, for instance, Netflix, which we'll look at in a little bit, they report earnings pretty soon. If you are not looking to target their volatility during earnings, if you're just taking a regular swing trade, you have to understand that there is an extra 15 to 20% possible volatility that can enter your trade without you knowing it. So if you're just taking a swing trade and then it gaps down 20% the next day, you can end up losing a lot more than what you thought was your stop point because you weren't aware of the fact that it has earnings and the fact that it can be volatile during earnings. So make sure that you pay attention to the earnings report whenever you are looking at a trade over the next couple of weeks because it could severely impact your account. All right, so that's SPY. Those are the levels on SPY that I think are important. I think overall, like I said, we're in a bullish environment, and until I see something change, I'm going under the assumption that we are still trying to rally and we're still going to make our way upwards rather than down. Now, we look at the NASDAQ. The NASDAQ and the Qs are actually the strongest of the four indices today. You can see we're up 0.3 on the SPY, 0.6 on the Qs, zero point 0.1 on the Dow, and actually a little bit red on the Russell 2000. You can see here on the top right. For the most part, the NASDAQ has actually been the weaker index over the last couple of weeks and even the last month or so. And so it's nice to see a little bit of rotation here. Part of that is due to the small caps being tired, and this happens often when you have a rally of the nature that we're getting right now, which is a little bit more of a stair-stepping type of a rally where we're slowly climbing. You get these little areas of consolidation, then you bump up, and then you bump up again. And again, I'll show you with the rectangle tool. Like I said, I said this last week. I know you guys, most technical analysis analysts use just trend lines and moving averages, but sometimes a rectangle gives you a really good view of these ranges where you have an established value, an established area that you consider to be overpriced. And so as you can see, again, been stair-stepping. Nice little stair steps. Even over here, we've got a little one here, followed by the more volatile one, and then followed by the most recent one, which is just a little flag, right? And so when you have a market that's kind of climbing up in that manner, a lot of times what you get is rotation back and forth between different areas of the market. So the market overall kind of slowly grinds up, but what you have is you have certain areas that climb higher and then they take off and then they rest for a bit, and then you have other areas that come back and try to take the mantle of leadership. And so what's happening right now is for today, the Qs are taking the mantle of leadership while IWM pauses. And when we get to the small caps, you'll see why IWM is pausing, because they've actually been leading the way over the last week and a half. And it's reached the point now where they're the ones that need to take a break and get some profit taking in while some of these other indices catch up. So, the Qs right now are the ones that are catching up. You'll notice they're doing kind of the same thing. Just a little flag here. You can actually say that they're actually trying to break out. If you really want to get short term and say that we've already printed a flag, right, and we're starting to break out. But I think in this case, it's probably better to be a little bit more conservative about this and say that we're really still within a bigger flag that just hasn't fully formed yet, and say that we're probably doing something along these lines, and go from there. But generally, it's the same thing that I pointed out with the rectangle. We have their nice moving averages. Again, look at the 20 climbing upwards, the 50, the 200, all indicating a nice trend and a nice rally going on. Price action has, for the most part, conformed to the 20-day moving average. It hasn't come back to test the 50 yet, showing that, again, the bulls are supporting price action pretty quickly. They're not waiting for further value. They're not trying to. They're not trying to be overly cautious about waiting for a big drop and missing out on the move. When that happens again, usually it's the 20 that's going to support price action, and then eventually you'll get the bulls get a little bit more cautious as you move higher, and that's when they decide they want to wait maybe for the 50-day moving average, and at that point we start to get a little bit more neutral price action. So a lot of what I said about the SPY is going to take place for the NASDAQ as well. It looks like we're going to try to push for all-time highs in the next couple of days. If you are concerned and you feel like this market environment is a bit of a mirage, well then the first warning signal is a break of the 20, as well as this area right around 312. The next potential area is right around 308, which will probably be close to the 50-day as it comes up to meet price. And I probably don't expect price action to breach the 50 unless there's a lot more negative news, or unless their earnings in the next few weeks is pretty poor. Um, but the next level beyond that would be right around just below 300, around 299, 297, and that is actually a pretty critical area because again, that's actually an important high that we printed last year, and that would be the key area that you really want to gauge as far as whether this market continues to move forward and continues to climb or not. So in the short term, the 20-day moving average and this 307 is critical. In the intermediate term, or more long term, we're more concerned with the 297 to 300 area. And of course, even further down, we can come all the way down to the 200 and still be in a bull market. But that's not price action we need to concern ourselves with right now. There isn't any hint of a reason why we would be coming down to that area at this time. So that's not really in the cards. What we need to concern ourselves with is short-term price action. From here to next Wednesday, or from here to the next couple of Wednesdays, we shouldn't really expect a breach of 300 or a little bit below that. And as long as that happens, we're still in a range-bound market. Now, also keep in mind, because we're still long-term in a pretty strong bull market, all those areas I just pointed out, if we do come up to those areas and we don't break them, then that becomes a good buy-the-dip opportunity, and that becomes an area that you probably want to focus on as far as taking shots to the long side rather than panicking and thinking that it's time to get out. Until they actually break, you should look at them as forms of support and look at it as a possible area for you to go ahead and try to allocate more stocks that maybe you missed out during the last several months. All right, so here's the Dow. You'll notice with the Dow that we have a little bit of a different picture here. It's the same sort of pattern, right, where we've got our bull flag and we're consolidating just below all-time highs. Matter of fact, you can see with today's price action, we're almost at all-time highs. But the difference being, you can see we have a pretty clean channel that we've been kind of trading up. Now we have been, there is a little bit of a stair-stepping going on here as well. And sometimes it's funny, you put some trend lines and they could change your perception of a chart compared to what it is without them. But you can see we had some price action that eventually turned into another rectangle here, which turned into another rectangle here, which then finally, of course, turned into what we're seeing right now, right? So there is still some stair-stepping going on here. And again, that's indicative of a market that is rotating back and forth between different areas and slowly just climbing up. And again, nothing here is negative. Everything is normal price action. Matter of fact, this is kind of bullish in the fact that it's not getting overextended or overbought, because every time that we break out, we pause for a bit and make sure that we get a new balance and new buyers to come in and step in and support price rather than just, trying to force people to chase price action, which is typically when these rallies get a little bit more difficult to trade and a little bit more dangerous, is when you don't have any kind of selling impact whatsoever and you just kind of climb steadily upwards, which in a bigger picture is sort of what's happening here. But because we keep having these ranges inside of this, we've had enough of a change and enough of a pause where the price action isn't overbought right now because it's kind of just climbing slowly and steadily as we just kind of chug along, rotating back and forth from one area to the next. So overall, like I said, this is still pretty bullish, and you can see we're ready to break out again. We're ready to try to push through that level. The moving average is also bullish. You've got the 20 and the 50 spread out pretty good. You've got them climbing upwards. Really, price action hasn't come anywhere near the 50. We had a couple of attempted breaches of the 20, but they held, and this trend line held. And so overall, again, it's bullish. I started off the year thinking we were going to be maybe a little bit more negative, but so far the price action is pointing in a different direction, and so we have to go ahead and respect that and make sure that we don't fool ourselves into not participating when the market is giving us good price action. All right. So as far as the Dow Jones is concerned, what are the key levels that we want to watch? So the first one is the short-term level here, right around 308. And that is the very short-term level that if we lose that, more than anything, it just signifies that we're not ready to break out. And it means that we need more time to maybe build another one of these bases before we try to stair step higher. Uh, Below that, we've got this area right around 305, which is going to be important, particularly on the Dow, because as you can see, it's going to be a convergence of several moving averages and levels of potential support. We've got this ascending trend line. We'll have another, we'll reappropriate this trend line here. You've got horizontal support here, and then you'll have the 50-day coming up. So this is going to be a convergence of several potential areas of support, and that would be a really critical area if we do pull back to that holds. But however, even if we lose that, even if we lose the 50, as long as we hold above this range here, right around 292, 293, we're still in a pretty good bull market, and everything is still intact for us to continue pushing upwards. It just means that we're range bound to start the year. And again, we're not really at this point seeing any hints of that. But if we do start to get a lot of selling pressure, that's what I'm looking at and what I consider to be the critical areas that should support price, or at the very least slow down any kind of a sell-off. All right, so the last thing we want to look at is the small caps, the Russell 2000. And as you can see, the picture again is very different. In this particular case, we do have a little bit of an overbought condition, and we don't really have quite the same stair-stepping that we saw in the other indices. Now, IWM has been very strong since the close of the year, and I think a lot of this has to do with the fact that we have an economy that should be opening up with the vaccine coming out, with people just getting kind of tired of staying home. And this is kind of reflected in oil, which we'll get into in a minute. And we're finally starting to see a recovery in this sector. IWM has been lagging. The small caps have been lagging throughout all of 2020. Matter of fact, they've been lagging for several years, actually, indicating that maybe traders were still having one foot out the door as they kind of were worried about the market. But that's not really the case right now. Right now, they are by far the most bullish index, and they are the index that is really pushing the way forward and leading upwards. And that is usually indicative of a pretty I guess greedy market is the best way of putting it. A market that is not really concerned with losing, not concerned with fear. They're just looking for return right now, and as such, they're ignoring any potential risk or volatility that's associated with the small caps, which tend to be the riskiest or the most volatile assets. So this is usually a good proxy for risk appetite, and it's showing that traders are, at this point, they do have an appetite for risk and are willing to assume it. And so we're leading the way upwards, and that's typically what you want to see in a stock market rally. So overall, pretty good. Now, like I said, the weakest of the four today, but I don't think that's anything that really, that's not any kind of real indictment on IWM's price action, because it's been up so strongly. It just needs to take a breath, catch its breath and take a little bit of a breather here. Overall, the one issue I would have with this is that while the other indices are printing nice bull flags, this is printing a rising pennant, which is typically not a good continuation pattern. Because again, this is indicative of chasing and of traders kind of being forced into buying higher than they want with poor risk reward, and that will often lead to a kind of a quick snapback. But as you can see, we had a little bit of that happen at the end of the year, and sometimes that's only a 2 or 3 day thing to kind of shake it out and to get things back to normal, and then it just kind of resumes its regular climb. So it's not the end of the world. This isn't any kind of real topping sign. This isn't something to be overly bearish about, but it is a little bit of a thing to kind of worry about as far as making sure you don't chase price action. You don't get too caught up in charts that are printing a rising pennant like this. This is not what you want to buy. Not saying IWM is not going to continue leading the way higher and isn't going to be the strongest, but as far as trading is concerned, trading's a game of probabilities, right? You could find the best looking chart setup that you have and enter it, and it fails. And it doesn't mean that you took a bad trade. It just means that the probabilities didn't work out, because whenever you take a trade, you're kind of playing a numbers game where you have an edge, but that edge is usually maybe 5%, 10%. So you're looking at, instead of 50-50 coin flip, you're looking at maybe a 60% chance of a trade working in your favor. And if that's the case, that's actually pretty good odds, depending on your risk and your reward. And it could lead to being a very profitable trading strategy. But it's still a game of probabilities. and so you can't really control whether your trades win or lose. The only thing you can really control is how much risk you are willing to assume. And even that can be a little bit sketchy sometimes, because sometimes you have overnight gaps that can lead further down than what you were anticipating as your stop. But that's why we have other kind of risk management procedures like overall position sizing and stuff like that. But uh, basically, you can only control what you're risking. Um, and so because of that, even though IWM can probably go upwards, it's not a good trade because the risk is poor here, because you have more downside before you get to a good level of support than upside. Now, upside, of course, is unlimited theoretically, but when you have something that's climbed this quickly, there's a good chance that it's going to have to take a breath, take a breather, and kind of come back down. And so it could be that this chops back and forth as it gets a little bit of profit-taking price correction, and you get shaken out of a trade because you decided to chase it because you were worried that you were going to miss out on the trade. So that's the one issue I really have with IWM. It's just at the moment it's not really in a good spot for us as far as risk reward is concerned. But other than that, it's a very bullish chart. Nowhere near the 20. Look at the 20 and the 50, how steep they're climbing upwards compared to the other three indices we've looked at. Again, showing how strong the rally is. You've got the 200 finally coming up. It was flat for a long time because IWM, like I said, was kind of slacking a bit. And we're finally starting to see that rally, really build up in the long term. And so overall, I think if anything, this is the perfect picture of what's happening with the market, where we are we're getting a pretty strong rally. We're getting really good price action, but it's coming in waves, and it's coming in different areas of the market as one takes a breath and the other kind of jumps in and starts following it. But generally speaking, this has been the area that is starting to play catch up, where during most of 2020, it was the Nasdaq and the tech stocks that were kind of rallying, and IWM was kind of stuck in sand. And I think at this point it's flipped a bit, where this is the index that now is playing catch up, while the S&P 500 and the Nasdaq in particular are kind of slowing down a bit as we get profit taking, as we get money rotating away from them and into some of these more beaten up names that were really at a good discount, but didn't really offer upside until we started getting hints of our economy opening back up. And I think that's what we're getting now, and that's why we're starting to see this kind of climb upwards. Right, so that's the four major market indices. Not a lot has changed as far as what I described compared to what we were last week, and I don't expect a lot to change from here to next week either. So for the most part, our trading styles should be the same as they've been for the last couple of days. As a matter of fact, as they were towards the end of last year as well, where we are just taking advantage of this positive price action, but making sure that we're not chasing and not having good risk reward in our trades. Now, before we get to the US dollar, I actually want to just look at oil real quick, because I think oil is very analogous to the small caps. And as you can see, oil has been very strong. We mentioned last week that there was a very good chance it's going to continue rallying, and it has done so. Very similar to IWM. We've got a sort of a rising wedge here as price starts to kind of run away. Now, in this particular case, I think this is getting a little overextended. Now, there is potential for this to continue climbing upwards, of course. It's only been, we really only have 1, 2, 3, 4, 5, 6, 7 days here of this particular burst of price action from 47.50 up to about 52 or 53. But I think there's a good chance that we are starting to establish a new price ceiling around $53. And that could end up being what becomes the area where we pull back. But just like IWM, what we're seeing here is the beginnings of a strong rally, right? So if you take a look at the moving averages, take a look at what the 20 and the 50 are doing. You got the 20 cross the 50 and starts to climb. You get the 50 turning up, and you see the space between them is getting wider. That, again, is a very good sign of the beginning of a rally, right? The 200-day finally starting to curl up, but this is still a little bit shaky as far as what's going on with it, because it was actually declining, and this could still be indicative of a long-term sideways trend. But as far as the shorter intermediate-term trend is, you can see there's a strong climb upwards here. We go to a weekly chart and we take a look at where we are. Oh, I forgot. We can't actually, let's do this with USL. Get rid of that death wick from from back here. So if you take a look at what's going on here, and again, so these aren't crude oil prices, these are U.S. oil prices, but they're pretty close as far as the price action is concerned. And so what you can see here is that there is a lot of room for upside here, right? But we're starting to get to an area where there is going to be some selling pressure as we reach the floor of what price action was trying to hold before the coronavirus drop, right? And so we're starting to get back towards that area. And, you know, it's a commodity that's not going to just kind of have a short squeeze that goes all the way up to the top, at least not with respect to where our economy is right now. But the key thing to take away from this is that we are seeing a breakout and price expansion above the previous range. And you can see oil was in a very orderly range for most of 2020, or at least most of the second half of 2020, and only now is beginning to really start to explore above it. And this is a pretty nice rally, but what's going to happen is eventually it's going to find a ceiling, and then it's going to start backtracking, and then we're probably going to end up developing another one of these rectangles. But at the moment, it's just pushing upwards. And like I said, I think this is very analogous to what we saw in IWM a few months ago. As IWM started to break out of its own range-bound activity, and you saw the moving averages start to turn upwards. And so I think that's what oil is, and I think they're very related. I think a lot of oil names are small caps and are, you know, a lot of energy. And a lot of them are, you know, a lot of the IWM move that we're seeing is related to oil and to oil names. So I thought it was important to kind of look at them together before we look at the US dollar and oil, gold, silver, gold and silver. So as you can see, the US dollar finally had a bounce. It wasn't a very strong bounce, but it did find some support. And that actually had a little bit of an impact, more on Bitcoin than anything else, but we'll see it in a second. So as you can see, the US dollar finally found a little bit of support. Now, is this a truly established bottom? Not really. It's probably going to need to come back and retest 24 a couple times and, you know, just really hammer this in as a potential bottom before we could really trust it. But at the moment, the one good thing is it looks like the bleeding has stopped temporarily on the US dollar. If we look at the Euro US dollar, which is going to again be the inverse of this chart, you can see again the same thing. The euro was climbing upwards, and then finally the dollar had a little bit of a snapback to it. And while I would, again, this is still a bullish chart as far as the euro is concerned, but it shows that at least for the short term, the US dollar kind of at least has stopped the bleeding a bit, and is pushing the price action towards the more neutral variety. However, it's still looking like it could still struggle a bit as the euro gains some traction. But for now, we can say that the US dollar has at the very least stopped dropping significantly. If we look at the US Canadian, we should expect it to be struggling because because oil is so strong. So this is going to be one of the crosses that even if the US dollar gains traction, as long as oil continues to climb, it's going to struggle versus its Canadian counterpart. And so that's what we're seeing here, is it did have a nice little green candle, but it's already kind of coming right back down. And again, that's because the U.S. Canadian has a little bit of an inverse relationship with oil, and that's what we're seeing in this particular case. And then finally, versus the yen, the U.S. dollar actually did gain a little bit of strength. I think the yen, as far as the three currencies I like to track, has been the weakest versus the dollar of the four, or the three, but still overall the dollar's still weaker. And so we're coming up into another significant descending trend line, and the dollar has not been able to break that for quite a while. And so if this continues, then we're going to head right back down. So what exactly does this mean? It means in the short term the dollar is finally not dropping, but in the intermediate to long term there's still a lot of trouble. Now, strangely enough, this continues to not really have too much of a bearing on gold and silver. For some reason, the 2-day strength on gold actually knocked down gold and silver quite a bit, but you can see they're starting to find some support again. Overall, I'm just not excited about gold and silver. For whatever reason, like I said last week and the last few weeks, I don't know if it's Bitcoin. I don't know what it is. I'm not a fundamentals guy. I suspect some of it is because of cryptocurrencies and a lot of the younger generation using those as stores of value rather than gold and silver. But like I said in the opening of today's stream, what pays is price action. And right now, I'm just not too excited about the price action on gold and silver. When the dollar was cratering and just dropping, gold and silver were just range bound and just kind of slowly climbing their way up into the middle of a range. And as you can see with silver, it's going to be a little bit of a better picture, but the same thing. You had a nice little rally on silver, but it wasn't anything spectacular when you consider what the U.S. dollar was doing. So you come back down here and you take a look at the dollar, and remember, gold and silver usually have a pretty inverse relationship with the dollar because they're priced in dollars. And so while the dollar was really breaking down, we weren't really seeing much out of gold and silver. And so now that the dollar looks like it's maybe, I don't want to say the dollar's ready to bounce, but maybe slowing down as far as dropping, and it's going to start trading more neutral, possibly even a little bit up. That's going to just put more pressure on gold and silver that they don't seem to be really equipped to take handle right now. So for now, gold and silver are not in really in my watch list as far as something I want to pay attention to. Like I said, I think generally speaking, it looks like now the anti-dollar trade is really Bitcoin. And as you can see with the dollar bounce, the cryptocurrencies finally did have a little bit of a pullback. This is pretty significant if you think about it, going from 40,000 all the way to 30,000. Just shows the massive volatility you can get in Bitcoin. However, even now, if you bought Bitcoin here, you have the potential of another $6,000 or $7,000 just from here to there for it to come back up and retest its highs. Now, I would suspect that at this point, this is actually going to start establishing a range. I think this massive explosion is probably done for now, and we need to kind of backtrack and retest some of the previous areas that we've kind of blown through. But we'll see what happens, and I think some of it might be related to what we see out of the U.S. dollar. And again, for those of you that are here, if you don't have, I know it might feel like, oh, it's too late now to get involved in Bitcoin or Ethereum or any of these other cryptocurrencies because you feel like you missed a move. It's never too late to get involved in a stock, and it's never too late to get involved in any kind of an equity. You just have to understand what your window of opportunity is and what you're looking for. And so what I want to do is I'm actually going to use an example. It's going to be in a stock. And I used this in our Discord chat the other day, but I didn't really go into too much detail. But so if you take a look at Tesla, right? And there are a lot of people that feel like they missed out on Tesla. And not even just this year. If you go all the way back and you take a look at what Tesla has done since basically, say 2013, 2014, there are a lot of people that missed out on Tesla, and I was one of them. I didn't buy Tesla. I wanted to buy Tesla when it was way back in the 20s pre-split, which was really over here around $6. But I missed it on several occasions. However, this year, when we had the March drop with the pandemic, I was like, you know what? This is finally time for me to go ahead and take advantage and start to reallocate certain positions. And one of the things I wanted to do is reallocate in Tesla. Now, of course, I got a perfect entry, but that's only because we were in the middle of a huge market correction. But the point is, I still waited, and I was able to get something around this area, around March 19th, and this thing has gone up almost 10 times its value just from this year. Now, granted, this is a pretty wild move, and this doesn't typically happen, but I just want to point out that even something like Bitcoin, you feel like you missed out on the move, but you don't know how much further that can go in the next 5 years or 10 years, heck, even the next 5 or 6 months. And so what you want to do is you want to avoid the cognitive, there's a cognitive error called anchoring, where if you see a stock at a certain price, you anchor that as the price. So let's say you started following Tesla in the middle of the year and you think to yourself, well, this is a $400 stock, right? It's traded at $800. I don't want any part of this thing because I think it's a $400 stock because that's the price I remember on it. So what ends up happening is because you anchor that, you start to have these expectations of what you consider to be a good price, and it could be a price that's never coming back. So for Bitcoin, if you missed out all that price action in the 8,000s and the 9,000s, it could be that you think to yourself, no, Bitcoin is an $8,000 or $10,000 commodity. It's not a $40,000 commodity. And you kind of avoid that trade. But the truth of the matter is you could buy this at 30 and still make a quick 33% for it to go back to 40,000. So there are still opportunities for you. And there are still opportunities not just as a trader, but as an investor. You just have to make sure that you look at the chart, analyze it, and try to understand what you consider to be the point where you would come back in. And it could be that you don't enter this for another year, but you should have a plan of attack, and you should be ready for it when it does happen, like I was back in March. There was a lot of stocks that I felt like I missed out on, and I finally got my opportunity in March, and I added them to my long-term holdings, and I'm very happy with them. And of course, that was kind of lucky timing, but the point was that I didn't just tell myself, well, I'm never going to buy this stock because I missed the move. You still have to wait for the right opportunity and try to make sure that you take advantage of it when you can. Okay? And so that kind of covers it, by the way, as far as what I wanted to cover with oil, gold, silver, the markets. If anyone in here has a chart request, I'd love to see what you're looking at. If you have thoughts on these cryptos, if you have thoughts on Tesla or anything else, feel free to let me know. For those of you that follow me on Patreon, you'll know this week has not been that great. We had a failed trade on McDonald's, as it kind of faded right away and kind of gave back our trade. And then the other one we were looking at was Visa, which actually was never a trade, so this isn't a failed trade because it never actually triggered an entry, but it kind of gave up on us. But we do have Zoom, which is starting to do nicely for us. And you can see we had a nice range expansion candle yesterday showing that buyers are kind of stepping in, and it's attempting to break out today. But for the most part, this week, I haven't been too excited about the price action this week as far as some of the stocks that I like to look at. So if someone here has a chart that they're looking at, let me know what it is. Maybe we find something together that's a little bit better than some of the ideas I had so far this week. And if not, we could pretty much just call it a day for now. All right. Well, I guess no one has some chart they want me to look at. So, if same deal. If you guys have a chart you want me to look at, but you don't want to ask now, or if one comes up in the next couple of days, you can always follow me on Twitter. I'd be more than happy to answer those questions on there, or look at your charts on there. Other than that, hope you guys have a good rest of this week, and we will meet again next Wednesday.